All right, very good. Thank you very much for making this possible. So, and welcome to David, who is, you know, you don't know that, but who is now currently visiting Frankfurt the second time in 2 years physically, but he's never been here. So at least we have him online in a virtual session now. Thank you very much, David. We're looking forward to your presentation. The usual rules, 25 minutes, please go ahead.
You can see the slides and you can hear me well? Okay, great.
Yes.
So yeah, thanks for having me. So this is joint work with Tyler Beason, who's a PhD student at ASU, and Tyler is going to be on the market this year. So hopefully some of what I talk about can entice you to take a close look at his file should you be hiring. So this doesn't need much motivation, I think. So as you can see from the title, it's a paper on sources of risk premium. Or more specifically, sources of the equity premium. And so I'm pretty sure you would all agree that the equity premium is a very important number, if not the most important number in finance. And I think most of you would also agree that it's a little, to put it harshly, embarrassing for our field that despite this obvious importance and despite literally the hundreds of papers having been written, we're very far from agreeing on what actually causes the equity premium. So this paper is an attempt to contribute to this debate by showing or suggesting a new way to decompose the equity premium based on index option prices. So I will show you a metric that we can compute both in the data and in asset pricing models. And based on this metric, I will show you a very large gap between sources of the premium in the data and sources of the premium in sort of mainstream asset pricing models. And then I will use this evidence to argue that there's something missing with investors' risk preferences in these theories. Okay. So the nice thing about this paper is I can really present it in one slide. So here's my one slide. So the metric that we are going to propose, we call EPX for equity premium of X. And this is the fraction of the equity premium from returns below X. So it's a state space decomposition of the equity premium. And so here in this graph on the horizontal axis, you have monthly returns. And on the vertical axis, you have the part of the equity premium due to monthly returns of a particular threshold. Okay? And you can see this both for the data and for various models that I'm sure you're familiar with. So let me just kind of explain the curve in a little bit more detail. So if we look at the data curve, and again, this is estimated from options data and from returns on the market, then you can see that this curve has a level of 0.1, roughly at a return of minus 34%. And so what that means, the way to read this is to say 10% of the equity premium is due to returns less than 34%. Okay, so we're basically decomposing the equity premium into different regions of the market return state space. Okay. And then you can see, so this is kind of cumulative, right? It's the fraction below. So the curve very steeply increases over this gray shaded region, and it actually cuts 1 or 100% at a return of minus 11%, which means that the entire equity premium is due to monthly returns of minus 11% or worse. Okay. And I've shaded this gray region here because this is the area that accounts for 90% or essentially all of the equity premium in the data. And so this is, as you can guess from the figure already, what we're going to contrast with existing models. I'm sure many of you will also wonder what are these wiggles to the right here. And so this has something to do with the pricing kernel actually being slightly U-shaped when you project it onto returns. We discussed this a little bit more in the paper, but I won't have too much to say about it here. This is kind of a well-known literature, as many of you know. Kind of the pricing kernel puzzle comes from this. Okay, so now let's turn to the models. So if we look at the long and risk and habit model, they are to the right here. And the first thing you'll notice is that these curves are very, very low, even at the end point of the gray region, which means that essentially none of the equity premium in these models is attributable to returns in this region. And I should also say that we use the original calibrations here, so we've done nothing to the models. And instead of attributing returns to this region, apparently roughly half of the premium comes from small negative returns, the region here, and half of the premium comes from small positive returns, actually. And you can also see that the models look almost identical, which I think is a little ironic given how much effort has gone into arguing over one mechanism over the other in this literature. So at least from this perspective here, it looks like they generate the equity premium almost in exactly the same way. What looks very different, obviously, are the disaster models. So let me explain the Barrow line. And if you have taken a closer look at this model before, then you will know that the way disasters are modeled is basically based on the empirical distribution of disasters that were observed internationally. So there are roughly 100 such events that Barrow accumulated throughout international data. And literally we stick this histogram into the model. And every once in a while, very rarely, we draw one of these events. And so maybe unsurprisingly, you can see that the line increases a lot in the very far left tail here. Okay, so that means that most of the equity premium comes from returns in this region. And in fact, the first jump here, that's the worst disaster realization out of the 100, that alone accounts for 1/3 of the equity premium. And the worst 5 account for 2/3 of the equity premium. So it's very literally a disaster model, like, so very extremely so. The worst 5 events account for 2/3 of the equity premium. And if you look now at the gray region, by the time we enter the gray region here, this line is almost at 1, okay, which is to say that almost the entire equity premium comes from the extreme left tail, okay, which I think is very intuitive. And just to make sure we're on the same page, so the level here in this gray region is not what you want to look at. You want to look at how much does it increase, because this is how much this region actually contributes. And you see it increases very little. So almost none of the equity premium comes from these sort of more moderate left tail events. Yeah? In Jessica Wachter's model, this is very similar. So to fill you in case you're not familiar with this model, so she assumes that the probability of disasters is time varying and persistent. And if you couple this with an Epstein's agent, who's averse against a late resolution of uncertainty, then you basically have a long run risk channel. And so in her model, the returns to the left of this region account for 2/3 of the equity premium. Right? So that's kind of this value here, instead of almost all of it for Barrow. And then the remaining 1/3 sits to the right of the gray region, and that's the long run risk contribution. You can see it looks basically like the long run risk model here. So it's like 2/3, 1/3, but in all 4 of these models, I think it's 6% or less of the equity premium comes from the gray region, where in the data, it's almost its entirety. Okay. So this is really the paper in a nutshell. But I would love it if Christian would continue talking to me after the conference. I'm not going to cut it off here. So I do have some backup slides to fill in what's actually going on here. So the plan for the rest of the presentation, I know this is fairly abstract here. What is this weird object EPX? So I'm going to go through this in a little bit more detail. I'm going to explain how we compute it, how we measure it in the data. And then I will show you a little bit more detail about what accounts for the discrepancy between data and models here. Okay. So let me start by trying to connect for you the equity premium with option prices. So on top here, I am simply writing the equity premium as an integral. So you can see the expected market return is simply the integral from minus 100% return to infinity of the return, times the conditional return density, integrated over all returns. And then the one assumption that comes in here is I'm going to assume no arbitrage. Okay, arguably not a very strong assumption. So I'm going to write the risk-free rate as the expected market return under the risk-neutral measure. Okay, so that's the integral I'm subtracting here. It's the integral over return times, and I'm using this asterisk notation to denote the risk-neutral density. Okay, under no arb, this is equal to the risk-free rate. Okay, now the idea of what we're after is to say, well, wouldn't it be nice if we could measure this integrand here? Because then we, instead of evaluating the entire integral, we could evaluate it over parts of that region. We could kind of see how important are different regions. Okay. Now the challenge in doing this is an econometric challenge, which is it is fairly difficult to measure the conditional distribution of market returns without making strong assumptions. Yes, there are definitely, obviously many papers have tried so. So this is a big literature on the pricing kernel puzzle. Victor Todorov and Tim Bollerslev have a paper where they're using extreme value theory, but this requires pretty strong statistical assumptions. And so we don't want to go this route. And so what we do instead is we'll just take the unconditional expectation here. Okay, so the second equation here is the average equity premium. And the left-hand side is what we would typically measure based on historical realizations. We just take the average. But we're also taking the expectation on the right-hand side. And if you do this, then the average of this conditional expectation becomes the unconditional density. Okay, so the unconditional density is not very challenging to estimate. We can just take a time series of historical returns, and we can essentially estimate the empirical distribution. Okay, we don't need a lot of high-tech statistics to do this. And then the second object, so the conditional risk-neutral distribution, we can obviously measure from option prices. So you can do this in every day, and you just average this across days, and that gives you this average risk-neutral density here. And if you like, and I like this interpretation, you can also interpret these things as error-proof state prices. So then this F density, you could say is the average payoff of an AD security that pays you $1 if over some period the return turns out to be R. Okay, so it's literally a state price. Sorry, the expected payoff of an AD security, and F star is the forward price. So that's what investors are willing to pay. And so if you're looking at a return that investors are very averse against, then they would be paying a very high price for an instrument that pays off when that return occurs. And so then this forward price F star would be much higher than the expected payoff. And so that's kind of what sits in the left tail, if you will. So the strategy now empirically is very simple. Okay, we're going to measure the F density as the empirical distribution of realized returns. We're going to measure this F star from option prices. That's going to give us the integrand. And then we're going to evaluate this integrand over different regions. And here is what this metric looks like as an equation, EPX. So on the bottom, I've just repeated the integral I just showed you. Okay, so this is the average equity premium, exactly the expression from the previous slide. And on top, I've repeated the expression, but I'm only evaluating up to a value of X here. Okay, so it's the part of the integral that's due to returns less than X. Okay, so this has a very simple interpretation. It's the fraction of the equity premium that is due to returns or states less than X. Okay. Also, if you look at the equation, it's easy to see that this is going to be increasing for states that contribute positively, and it's going to be decreasing for states that contribute negatively. It's also going to have a value of 0 if you evaluate at a lower bound of integration, -1, because no return is worse than -100%, and it's going to have a value of 1 kind of to the very right. And here's the figure again. So with this equation kind of on the slide, I think it's easier to see where this comes from. And so I've explained how we've done it in the data. So I should mention, obviously, this is for the S&P 500. So we're using option prices to compute F star. And due to this, it's the sample starts in 1990. So we have roughly 30 years of data that's limited by the availability of option prices. And then we can do the same thing in these asset pricing models, right? We can price options, we can estimate these densities, and we can decompose the risk premium. Okay, so now I'm going to show you one more thing, and then I'm going to try to make this sound a little bit more familiar. So I'm going to talk a little bit about statistical uncertainty in this measure, in the data measure. And then I will translate this back to the terminology that everybody's more familiar with, the pricing kernel terminology, that I think most of us have thought a lot about in terms of these models. And then we can see kind of where does the discrepancy come from. Excuse me. So here's the bootstrapped sampling distribution of EPX, or more specifically, EPX evaluated for different regions. So imagine you have the entire return state space, all possible returns. We're going to chop this into 3 regions. Returns below -34%, that's the kind of the 10% left tail. The gray shaded region on the previous graph, that's 90%, that's almost its entirety, and a remainder. So what we're going to do is we're going to bootstrap the data, both the risk neutral distribution and the physical distribution, and then we're going to keep recomputing these objects. And so this is the joint sampling distribution of the far left tail, if you will, and the kind of medium left tail. The third category is the omitted category that's implied. And so the way to read this is you can see that the density almost entirely lies to the right of 0.5. Okay, so what that means is, so this is actually 97% of the mass. I'm 97% sure that the majority of the equity premium, or more than half, is due to returns in this gray shaded region. Okay, so we can be fairly confident statistically that this is the main source of the equity premium. And you can also ask yourself, well, is it possible statistically that maybe disasters are the main source of the equity premium? And this graph says no. Right? So 98% of the mass lies below the 0.5 line. And so I'm 95% sure that the far left tail is not the main source of the equity premium, that it accounts for less than half of it. Okay? Now, I think the strength of this result really lies in its simplicity, right? We have assumed one thing, we've assumed no arbitrage. Other than this, it's literally just the data, right? So there were no fancy statistical assumptions. Yeah.
You got 10, David?
10 minutes, thank you. Yep. So now let me try to kind of make this sound a little bit more familiar. So what I'm going to do is I'm going to write the equity premium in terms of the pricing kernel. And then we can think about why do the models look so different from the data. In this expression, you can see that there are three things that matter for how important a particular return state is for the equity premium. So I'm still writing things as an integral here. And the three things are, how big is the return? So if it has a big magnitude, either positive or negative, all else equals, it matters more. Okay. Secondly, how likely is it? So this is the return density, right? A return that is impossible to occur obviously is not going to have an effect on the equity premium. And all else equal, the more likely it is, the more important it is. And the third term here depends on the pricing kernel. And so if you stare at this for a second, then you will see that if you're looking at a negative return, so if this R is negative, then this will contribute positively to the equity premium if it's associated with above average marginal utility. Okay, so if the pricing kernel, given this return, some people call this the projected pricing kernel, has an above average value, right? So if it's higher than the kind of non-conditional expectation, or just conditional on T, but not on the return outcome, this is bigger than 1, the difference here is negative, multiplied by negative R, and it's going to contribute positively. So this is fairly intuitive. If you have a bad negative return, it's bad only if it's associated with high marginal utility. And then conversely, if you have a positive return, it would contribute if it's associated with below average marginal utility. Okay, so why is this useful? Because in the models, we have a little bit of a sense for what returns are likely and what does the pricing kernel look like. And so we can now take this to the models and say, well, if a particular return doesn't contribute enough relative to what I have showed you, is that because maybe it's not likely enough, or maybe because marginal utility isn't high enough? And so we can now be very explicit about what causes this. And just to set the stage, I'm going to start with a very simple model to kind of show you how these things affect the EPX curve. So this is a log normal IID model. Okay, so consumption and dividend growth are log normally distributed. The dividends are a little bit more volatile than consumption. This is roughly calibrated to the data, but this is not about numbers. This is really more about kind of what things look like. So I'm going to take Epstein's in utility, assume a high ERS to get a low risk-free rate of 1%, assume a very high level of risk aversion. It's an IID model, right? So to get 8% equity premium, so roughly we match kind of the data. And if you look at the bottom right, this is the EPX curve for this model. And you may notice that this looks almost identical to Campbell-Cochran and Banzal-Yaron on the first slide. And that's in fact not a coincidence. That's a consequence of log normality, and these other models are conditionally log normal. Okay, so let me explain where this comes from. So if we're going to look on the left, we see the two return densities, physical and risk neutral. And you can see that the risk neutral density is essentially just shifted to the left relative to the true density. And so that means that we are overweighting negative returns by about as much as we're underweighting positive returns. Well, and that's because of this, half of the premium comes from negative and half comes from positive. So this is literally just a consequence of log normality. Now, Banzal-Yaron and Campbell-Cochran are not IID log normal, right? They're conditionally log normal. And these dynamics are there so that we can explain return predictability, etc. But for how the models price these different return states, that really doesn't matter, right? The fact that they're conditionally log normal, they look like an IID log normal model. Okay, so why is the equity premium contribution of the gray region so low? Okay, we can again look to the left where there's little probability mass. Well, that's a log normal model, right? Of course, there's not much mass here. And then I said the second thing is kind of from the pricing kernel. So here you can see the projected pricing kernel. And I have not showed you the data equivalent. We have this in the paper, but I will show you this on the next slide in terms of a statistic. This is also very low. Okay, so what I'm going to do, because I would like to show you this for all of the kind of well-known models, but I don't want to show you 20 pictures. So I'm going to focus on a few key metrics here. So I'm going to compute what fraction of the equity premium comes from the gray region, first number. Okay. How likely is the gray region, second number. And what is the ratio of state prices to payoffs? Okay, so this you can interpret as the pricing kernel in an IID model, and otherwise just as kind of how much investors willing to pay relative to the expected payoffs. But it's something we can easily compute in data and models. So I'm going to show you these three statistics. Okay, and I'm going to do this for all of the other models.
That's 5.
Yep, yep. Thank you. So here again, you have the data. In the data, 90% comes from this region, and all of these statistics are just for that gray shaded region in the graph. It accounts for 90%, has a probability of 1.1%, which is about one event every 7 years. Okay, once every 7 years, we see a return that is so bad that it falls in the gray region. And the ratio of risk-neutral probabilities or average risk-neutral probabilities to average physical probabilities, or if you will, the forward price to payoff ratio is 3.2 in the data. Now for this IID model, we saw almost none of it comes from the gray region, 5% instead of 90. The probability is too low, it's half of what it is in the data. In this price to payoff ratio, which is reflective of marginal utility, is also roughly half of what it is in the data. Okay. So apparently from this, and if you look at the asterisks, these are small sample p-values. If you like, you can reject the model. I think that's not as important. The economics is more important. So we have too little probability mass. We have too low of a price of risk for these tail events. Okay, so now let's look at Banzar-Yaron and Campbell-Cochran. And once again, you can see that they are basically like an IID model. Okay? 5% roughly of the equity premium comes from this region. The probability is about half of what it is in the data. The price of risk is also roughly half of what it is in the data. And so from that perspective, these dynamics really don't matter. Okay, so they are not important for how the model prices different return states. Okay, so what can we do in order to match sources of the equity premium in the data? We can try to do anything we can in order to increase the probability or the price of risk. Okay? Now, the price of risk, we know how to deal with. This is gamma. Okay? But we can't really increase gamma because then we're going to overshoot the equity premium. Okay? So that's a no-go. We'll have to manipulate the shocks. So let's see what happens in models with more tail risk. Okay, so here's the bazooka right away, the maximum amount of tail risk. So in the barrel model, we have really low risk aversion. Because of this, the pricing kernel is super flat in the observed region. The two densities here look basically the same. But if you go all the way to the left, you see these little wiggles here. And I've magnified this a little bit. These are the disasters that are sitting over here. And on the right axis, you can see the pricing kernel has a level of 100. If you move far enough out, right, even with risk aversion of 3, the curvature kicks in eventually. And we're inflating these probabilities by a ratio of 100. And so the worst disaster accounts for 1/3 of the equity premium, the worst 5 for 2/3, and the entire premium sits over here. Okay, in terms of the numbers, 2% of the equity premium comes from the gray region. The probability is way too low. Why is that? Well, because we have small normal shocks to the right and large disasters to the left. The price of risk, well, this is still absence in utility. It doesn't look much different from the other models. Okay, so we don't have enough tail risk, or the wrong type of tail risk, if you will. So what about Jessica's model? Again, time varying disaster probabilities. They make the price dividend ratio fluctuate. You get a little bit more return movements. And so now you have more probability mass. Right? So the gray region now, you would imagine that this density is a little bit wider, right? That's because of excess volatility. It's not quite wide enough. Apparently, the probability is still a little bit low, but 5% of the premium comes from the region. The price of risk still looks like in the barrel model, way too small. Well, it's the same utility function. Okay? So based on this, and I want to stress, based on how we commonly model disasters, disasters are not an important source of the equity premium. Okay, so we need more probability mass in the gray region. What can we do, right? We can work with, we give up all the least tractability of normal shocks. We work with skewed shocks. And of course, people have done this and realized in other contexts the shortcomings of these models. And so here are 3 extensions that I'm going to take as they have been presented in the literature. The first one, the Beckert-Engstrom, is an extended habit model. The next one is an extended long-run risk model, and then an extended disaster model. And so in all of these, the people are trying to match option prices by introducing left-skewed shocks. Okay, you can see that the probability of events in the gray region is now much, much bigger, actually much bigger than the data. In the first case, almost by a factor of 3. But despite this big probability, the region only accounts for 1/3 of the premium. That's still statistically significant if you want to do a test. And so why is that? The price of risk is still what it was before. Okay, why is that? Same utility function. We didn't change anything. We just changed the shocks. Okay? So from this perspective, I'm basically done here. It's not enough to just inject more probability mass into the left tail. It's not just the problem of log normal shocks. The problem is really with the utility functions. You can only increase the price of risk if you model utility differently. And so this is the puzzle I leave you with. So we have seen this big discrepancy. And just to do a little bit of self-advertisement, I have another paper that was just published in the RFS where I'm building such a model with a different utility function. Exactly with the purpose in mind of increasing the price of tail risk, and not surprisingly, it kind of goes at least part of the way towards matching this. But I think we are by no means done. So the question this, I think, hopefully it kind of brings up is, what does this tell us about the pricing of other assets? Bonds, currencies, cross-section of equities. Obviously, utility functions are important there also. Are there any connections with the findings of Ralph Cohen and co-authors, the term structure of the equity premium? Right? We kind of look at the cross-section of small and big shocks. They look at persistent and transient shocks. Maybe there's a connection there. Can we write down a model that's a little bit more explicit in terms of micro-foundation, maybe with frictions, heterogeneous agents, incomplete markets, so that we don't have to play with exotic utility functions and kind of rationalize the equity premium that way? So I leave you with these questions, but I think that this is an important new angle of how to look at, can we generate a realistic equity premium? So thanks again for having me, and I'm looking forward to Rüdiger's comments.
Thank you very much, David. Before Rüdiger starts, I just want to say that probably there are some people in the audience who have their opinions on what shapes of the pricing kernel might be or so. So that would probably give a basis for a very interesting and stimulating exchange. But then, without further ado, Rüdiger, the floor is yours, and we're looking forward to your discussion.
Yeah, first of all, thank the organizers for the invitation to discuss this paper, which I find very exciting and which gave me a lot to think about. So on a very high level, there are 3 things that all asset pricing models do. Right? So the first thing is that they define an n-dimensional state space. That is, the model states which kind of variables span that state space, which kind of states of the world exist, what the world looks like. And secondly, the model needs to take a stand on how likely it is to move from one state to another, and as a consequence of that, what the unconditional physical probabilities of ending up in a certain state are. And then thirdly, the model needs to say how much the agent in the representative agent model likes or dislikes being in a certain state of the world. And when we combine that with the physical probabilities, we can get state prices, right? And if we project that n-dimensional state space onto one dimension, namely market returns, then we can recover those state prices empirically using option prices. And this is something that has been done in the past already. What's new about this paper is that the authors use these option implied state prices to decompose the equity premium into compensation for realizations of the S&P 500 returns. So compensations for the S&P 500 having a certain level of return at some point in time. And this is what the authors call the sources of risk premium. The authors then go on to compare those sources of risk premium that they found in the data with consumption-based representative agent models. And they find that models with a high market price of risk for states corresponding to -35 to -11% return on the S&P 500 have the best fit, right? So that was a very brief summary. I have a more extensive summary later on. First, I'd like to talk a bit about state prices in n dimensions, because it's going to be important for the comments there. Right. So as I said, the model needs to say which kind of states of the world there are. And for instance, we could have two-dimensional space where I could say one of the dimensions is the market return and the other one is some state variable. It could be volatility, for instance, but basically anything could be it. Most of the models that we work with don't have market return as a dimension. Dispense the state space is more typically it's consumption or other state variables like consumption growth of stochastic volatility, the habit level, or time varying disaster risk. And then the market return is just a function of being in those states, right? The KPM is different there, right? The KPM, the only dimension that matters for state prices is the market return. So now that we have this state space, right, we can assign physical probabilities to each state. So here, for instance, I decided to put a lot of probability onto states where the market return is very low and the state variable here is very high. And thirdly, I said we need marginal utilities, right? So I decided to have a high marginal utility for low return states, right? So the agent always likes a higher return better than a lower return, and always likes a low value of the state variable 2 better than a high value. When we then combine that with physical probabilities, we can get state prices, right? And so we can get much more evolved patterns there, right? Even though the marginal utility was conditionally monotonic, here we can get more evolved shapes. For instance, when we project this two-dimensional space into one dimension that's market returns, we could get something like this, for instance. And here, this is a bit slightly U-shaped, right? Where we have only one dimension anymore. Now, you see here that behind that, for each level of the market return, we can have very different values of state prices depending on what the other variable does, right? So we're missing out on that. But the nice part is, because the dimension that we projected onto is a market return, there are traded securities, there are options, so we can recover the state prices empirically, right? And this is also what this paper does. At the very center of the paper is the equity premium, right? And here in its conditional form, and we have the expected return on the market under the physical measure. The same thing under the risk-return measure is the risk-free rate. So when we deduct one from the other, we get to this expression here that sort of shows us that we can express the equity premium as integral over compensations for being in a certain state that's defined by the return on the S&P 500 on the market. So for instance, if we have a negative return R, and that state is a high marginal utility state, so F star is higher than just F, then this will contribute positively to the equity premium. So we have the expression. Next step, we need to estimate. F star. So one assumption that's made here is that dividends are known in advance. So there's no conditional dividend risk premium, and we can use option implied F stars here. The prices that we use to recover FT star could be using a fitted IV surface, right? So we can also use maturity minus combinations that we didn't observe at this point in time. And now that we have all those FT stars, we can go on to get the conditional F stars. We can go on to get the unconditional F star using data from 1990 to 2018. The other quantity F here, or there's no FT, right? So there's nothing about conditional probabilities. It's just the unconditional one, and that's estimated using realized ex-dividend returns in a frequentist manner. Okay, so now that we have these contributions to the equity premium, we can also say how much returns below a certain threshold X here contribute to the equity premium. This is measure EPX that I introduced. And so we see here that returns between -35 and -11% contribute to 90% of the equity premium. Right? So this is really where the kind of returns that investors are rewarded for when holding the market and receiving the equity premium. So how does it look in the models? And so authors simulate F and F star for various models, and then they compare what they, the kind of equity premium decomposition that the models generate to that from the data. What they find is that neither those normal models, these are conditionally normal, but they, as Tyler already explained, they look just like unconditional normal models, or models with consumptive disaster risk can generate that. Right? And it seems that a high price of risk for this gray region here seems to be key. So we either need a higher correlation of dividends with consumption in those down states, or a higher marginal utility of consumption in those states to begin with. And the authors show that models with a general deployment diversion and a higher correlation in jump risk seem to do the trick, or at least they come fairly close to matching what the authors have found in the data. Okay, so to my comments. So first of all, I have to say that I think the paper is fantastic at what it does. I think it's a really great paper, and it's also great for what it can do for the most part, right? So there are in particular data limitations. So I'd rather try to think about some open questions that I got when reading the paper, and also some implications that this may have for various asset pricing models, and also so to say inherent limitations of the approach. So the first thing I'd like to discuss is short horizon dividend risk. So, because this assumption that dividends are not in advance, the only rewarded risk, right, for which you get the difference between, for which you get this risk premium is longer run cash flow news then and discount rates, which I think is very much innocuous in normal terms, but maybe not necessarily in case of sudden downturns, right? So recently there were some very harsh dividend cuts, and those were rather sudden. So I think there is some short-term dividend risk in extreme states. In particular, these dividend cuts are associated with high margin utility states, where the difference between FT star and FT may be pretty large. And this sort of led me to think about the role of ultra short-run cash flow risk. And so not only in the data or in the empirics, but also in the models, because all the best models get their punch from cash flows in these monthly calibrations. And so I feel like it's a bit of a discrepancy that's worth thinking about. And relatedly, so over the past decades, it has been stressed a lot, right, that in order to explain excess volatility, we need substantial variation in discount rates over time, right? And this variation in discount rate translates into state variable variation. However, as Tyler also just showed us, this discount rate variation doesn't seem to play a huge role in generating any of the equity premium, right? Which I think is quite interesting, right? So it has this quantity which is probably super important at long horizons, but here it doesn't really seem to play a role, at least in the models that we look at here. I think one way in which all such as the long run risk model and the information model looks similar here. One thing that could sort of help those models to manage the data better would be to have a local correlation with dividends in the state variables, right? So at the same time that you get a negative dividend shock, stochastic volatility goes up or something like that. But then again, I think it wouldn't really be a pure discount rate effect. So I'm quite curious about that. Another point is dimensions other than the S&P 500 returns. So in the paper, it's explained very convincingly that there's no classic peso problem, right? So say we didn't have enough observations of very low returns, disaster return right here. Then if those were actually higher, right, having all else equal, this would lower the difference between F star and F for those returns which would mean that they would have a lower contribution to the equity premium. However, it may be that there's something of a Pearson problem in dimensions other than returns, right? So assume that this were, which often is not, but assume this were the distribution of the state prices across those two dimensions, and these were the observations that we had so far, then maybe they would just have not yet seen as many states of the world with high state prices for a given level of returns, right? So the question is basically, did we, between 1990 and 2018, observe states in dimensions other than the S&P 500 that would have high state prices that would then lead to a different estimate of F star here? So it's more of a philosophical point maybe, but also worth thinking about. It could also be that, yeah. Right. And relatively, the models are unlikely to have generated the equity premium decompositions in the data, but it would be really interesting to find out why, right? Because these are all models that many people have worked with and have studied a lot. So it would be interesting to see the grids from the models in the long run growth, stochastic volatility, surplus consumption, etc. space, to see how the state prices the models generate depend on those underlying drivers of returns, and also how they differ across different states of the world. And maybe one way in which to address it to some degree would also be to, as we're going from conditional FT star to the unconditional F star, how much does the empirical FT star move over time, which may give us some idea of how FT depends on the states of the world in the data also. Maybe they can be linked again to models. Relatedly, as you said, you use the standard calibrations for the models, which are usually done at least starting 1945 or so. And it would be interesting to see how, if the models perform any differently, if you were only to calibrate them to 1990 to 2018 data. I don't know if it makes any difference, but it would be interesting to see, because so we're in a rather short time given the actual high dimensionality that may be behind what we're looking at. And finally, I guess, I have a question about counterparty risk. So basically, if the world ends, who's going to pay me? Thanks. If the world ends, who's going to pay me, right? So we know that all of the money puts are, in a sense, too cheap because of counterparty risk. And besides concerns about or implications of market completeness, if there's really an 80 security that will pay me when the market loses 80% or 90% in value, it would be so interesting just if you were to adjust the IV surface to have sort of counterparty risk-free option prices, because we're not interested in what would actually be paid, but sort of in the hypothetical payment in the state of the world, I guess. So that would be interesting for me to see, and also I would be interested in how that may affect the sort of the weak performance of disaster risk models. And then if we're not entirely sure about the IV surface maybe and all that, and if we add that to sampling uncertainty about F and also F star, it'd be nice to see sort of if you put all the uncertainty together, how certain we can be that the equity premium decomposition is as it is in the data. Right, so to sum up a bit earlier, I guess, again, I think it's a great paper. I think it's very loosely written, very well developed. It's easy to read. And what I like most about it, that it really gives us an interesting framework to think about the standard models that have been studied so intensively by many of us. I think it's pretty cool because it sort of opens a whole new dimension, right? When you only try to match certain moments, something completely different than looking at this decomposition of the equity premium. So we get this new set of facts to match, but I think we should take some uncertainty about that into account also, and also not on the side of other goals, such as matching conditional moments, discount variation, and all that. So yeah, to sum up, I think there's a lot to look forward to from this, and yeah, congratulations on writing this great paper. Thank you.
Well, thank you, Rüdiger. As usual, question to the audience. Are there questions, comments?
Hi, if nobody else wants, I can start. I would have one or two questions. The first is, does what you do depend on the frequency? You probably have done this with monthly returns. How does it look for 2-month, quarterly, yearly?
Yeah, so yes, right now everything in the paper is just based on one month. But the way we fit the IV surface actually allows us also to go out a few months, right? Obviously, it's difficult to go out very far because then the option quality is not so good. But we're in the process of working this out for 3 months. So the obvious thing that happens is 3 months returns are more volatile, right? So this region is going to scale kind of. But we've tested it now for the Barrow and Wachter models, and it looks basically the same. Mm-hmm. So at least at 3 months, the region is not extreme enough to accommodate the disasters. Now I don't think that we're going to be able to really do this at an annual horizon, just because we have too few observations there. I think the models could potentially get closer to the data, but then most of the models are written kind of at this higher frequency, right? So mm-hmm. I think they should really be consistent with this at all frequencies. But the revision will have a result for 3 months in it.
The second point I want to pick on is probably not very surprisingly, and the U-shape of the pricing kernel. I mean, you kind of, at least what you presented, and I don't know the paper, you completely ignored this. And they said you're 90% of the risk premium is in the shaded area. But if you were to take it literal, then also a fraction of the risk premium comes from the upward sloping part. And if I don't know whether I actually can do that, but if you rescale everything to 100, and then it was from 140 to 40, there was actually like a third or something comes from the upward sloping part.
Yeah, so that was one of the comments we first got a lot when we presented this. So while in the APX curve, this actually looks very extreme. So what we do in the paper is we also plot the ratio of the average risk neutral to physical, which I know is not the pricing kernel, right? The pricing kernel would be the ratio of the conditional, which I know you have worked on. But if you do this with the unconditional, then you see a very, very slight U-shape. And so if the world was IID, which obviously it isn't, this very stark kind of thing in the EBX curve for the positive returns that you just pointed out, that we would be consistent with just a very, very slight U-shape, which is of course consistent with your work and the work of others in this literature. Right? So it looks very stark in the EPX curve, but actually for the pricing kernel, it doesn't mean that the U-shape is all that extreme.
Mm-hmm. Okay. Yeah, that was actually quite extreme for my taste even. All right, thank you.
Yep.
Other questions, comments? So David, you
just one quick question.
I'm sorry. Yes.
One quick question. I think that's a great paper. So I'm just thinking about, can you extend this to international asset pricing models? You understand what I'm saying, right? So I have the same idea when I read your paper. So I say, well, I could do the same looking at 2 countries, right? And then I could come up with a measure unconditionally in the same like you did, and use it to test all these international asset pricing models. So that's what I'm thinking of now. Yeah.
I think that's a good idea. I've thought about this too. So you could think about like for currency risk premium, right? What part comes from the extreme tail? So one challenge I think is that this is usually bivariate, right? So you're going to need some kind of pair option, I think, or something like this, which I'm not an international finance guy. This may well exist, or you may be able to do it with just kind of univariate options. But I think for sure, you could characterize currency risk premium in the same way. And I know that you've also kind of thought about these preferences, right? So it's also interesting to think about, like, if you write down a model that has this high marginal utility for these states, what would that imply, for the term structure of interest rates, for currency risk premium, etc. I think there's a lot to be worked out there.
Yeah. Okay. Thank you.
Yeah.
I see Julian Timmy has a question.
Yeah, hi. Well, you said to Tobias' question regarding the option liquidity for longer times to maturity that this is an issue, right? But what about very, very far out of the money puts and calls? They're also illiquid, no? I mean, isn't this also an issue? I mean, how do you address that? Because you look at returns of minus 90% or something?
Yeah, so this is in the models. So in the data, we drop, we have a long description of kind of all the data stuff we do that I didn't get to, but we drop price quotes below 50 cents. So right to the extreme out of the money puts are going to have very, even though they're kind of expensive, they have low prices. And so we cut off everything below 50 cents. So we're not going to actually use options for, minus 50% or anything like this. But we're fitting a smooth surface, kind of using a method that has been used a lot by practitioners and also kind of sort of in the academic literature. Indu Becker used the same thing in a recent paper. So you're fitting this thing. So really we're extrapolating to 90%, but we're extrapolating in a way that is kind of smooth. So we're not going to have a polynomial that kind of goes wild. And what we actually do is we impose what theory gives us. So we know that prices are positive, monotone, convex, and we kind of fit a smooth surface that way. Which also gets back to Rüdiger's point. So I don't think it's going to be terribly sensitive to how these extreme options are priced because they don't actually enter. And if I fit the same surface using just options that are closer to the money, it looks almost identical, right? Because the thing is almost linear if you kind of move away far enough.
Yeah, but do we know then? Sort of.
Do we know that?
No, we know. So if it's about something that's somewhere out there, then right, there's some uncertainty about that. What that would look like if it existed, or if there were.
Sure. I mean,
counterparty risk-free.
All I can say is, so in the more recent data, obviously we have options that go out kind of 10 standard deviations or so. And roughly speaking, between minus 2 standard deviations, minus 10 standard deviation, the IV surface looks very linear, right? So what does it look like at minus 20 standard deviations? Obviously, I can't say, right? But I can say that at least for what I see, it looks fairly linear. I can't say that it curves back up further out there, right? But I think we kind of have to do this with good faith. We have to say what we see, it looks like it's consistent with linearity. I can't prove to you that's not the case. I have to admit that.
David, I have a question.
Yep.
So first, thank you for agreeing to switching the order of the presentation.
No worries.
Author is here. I think we should be ready to go. But thank you so much for Christian as well to make the arrangement. So now the real question comes. So I think in your construction of your methodology, right, you are essentially requiring the models to be able to explain option prices. But we know Campbell-Cochran's habit model doesn't explain the implied wall curve, which to me is another kind of important metric to match in the data. So do you think of your method as another metric for these models to look at? Or is it just another way of saying the implied wall curve is not right under these models?
So I'm very glad you brought this up because I should have mentioned this. So it's absolutely not the same. So the easiest way to see this is I showed you results for the Beckers-Martin-Chernoff model, which was actually explicitly designed to fit the IV curve, right?
Right.
So what we do is it's not about fitting the IV curve. It's about fitting the difference between the physical and risk-neutral distribution. So in my mind, existing models have mostly fitted option prices by manipulating the physical shocks. The Beckett-Engstrom paper is another great example. They fit option moments, but they don't really fit the gap between P and Q, right? So what they do is they shove a lot of tail risk into P. Yeah, then you can match option prices, but you're not going to fit the gap. And so our metric is really about the gap. It's about the risk premium, right? The option prices are not risk premium. Option prices they can come from either physical properties or from a risk premium. And so what we do is really isolate the gap. And I think that makes for a much starker contrast.
So is another dimension on top of what the
I would say so. I would say so.
Thank you.